Very good evening to all of you. Welcome to the practical session 14 for the year 2024. And this will be purely based on demand supply trading methodology. So, myself, Srijit Kakar, today is 7th of April 2024. And before we move ahead with the session, let's get done with the basic formalities. So, make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So, like I said, today's session is the practical application of demand supply methodology. Now, if you have not yet learned the demand supply methodology, it is available as an absolutely 100% free course. And the link to the course content is available in the description. The course is available in both the languages, English as well as in Hindi. So, whatever language you're comfortable with, you can take the course in that particular language. And during these weekly analysis session, we get into the practical application that whatever we learned in the basic lessons, advanced lessons, how do we practically apply to some trading ideas to understand how to plan some trades. Now, today's example is a very beautiful example because I get a very common question, that is, what if we have multiple demand areas? What if we have multiple supply areas on the chart? So, how do I decide which demand or which supply area should I be using? And today's example is almost like a textbook kind of an example, which I would like to show that, if you are a trader who has one kind of a personality, you might have a different zone which you might be considering as an opportunity. But if you are, let's say, a trader who's more on the conservative side, you might be looking at a different zone as your trading opportunity. So, very beautiful example to look into. But yes, before we proceed with the session, I would definitely like to add, if you're not subscribed to my channel, make sure you subscribe to it so that you don't miss on any of these sessions. Ideally, I do these sessions every Sunday, 10 p.m. Indian Standard Time, but based on my availability, they can get rescheduled, and they have been getting rescheduled in the past. So the only way you'll get notified is if you're subscribed to my channel and you have the notifications activated. And yes, if you are available to join the session live, you can join it during the live session. Otherwise, the recordings are also available. So just in case you're not able to join live, later you can watch the recordings. And yes, I would highly appreciate if you're liking these sessions, like the video, hit the thumbs up button. And if you have some family members, friends who are into trading, you can also share the link with them. And even if you're on some trading groups, you can share the link. Somebody might get advantage of these sessions. So let's get started with our today's analysis. So, like I was saying, a very common question that I get. Let me show you what that query is. And today's session will also have a little bit understanding. I won't say a little bit, you'll have complete understanding how to handle such situations. So, the very common question is that what if we have multiple demand areas or supply areas? Like in this example, you can see this is my current market price. I have the first demand area, I have the second demand area, I have the third demand area. So at times we have that confusion. Okay, I have multiple ones, which one should I be using? Because the fact is, unless and until the trade plays out, nobody knows which one is going to play, which one is going to hold, right? What can happen is prices can react from this. And if you were looking for the second or the third one, you miss your trade. If you're looking at the third one, the first one, again, might give a bounce, might get stopped out, and then you might come into the second one, which can also work, which can also get stopped out. Similarly, if you say, okay, I'll trade all these three as individual zones, then what can also happen is maybe the first one you get stopped out, second one you get stopped out, and third one again might get stopped out, might work for you. So how do I decide that if I have multiple areas, which one should I be going for? That is also something we'll be touching upon when we do the analysis of the symbol with a very beautiful example. All right, so yes, when we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, do ensure you watch it. The link is available in the description. And during the session, if I talk about some videos or if I talk about some documents, the links are available in the description. You will be able to download or access those videos from those links. So, like I said, trading has to be mechanical and rule based, which has been explained in a video, which is how to start trading. And that is a process which everyone will have to go through eventually, because there is no bypassing it. Only once you go through that process, maybe once, twice, thrice, multiple times, then you start having that realization that trading is not about making money on each and every trade. Fact is, that is not possible. You will have winning trades, you will have losing trades. It's all about maintaining a healthy reward to risk ratio. If you have a healthy reward to risk ratio, you can be wrong more number of times, but you can still be a net profitable trader. So when we talk about being mechanical and rule based, what we need to do is we need to create a trade plan for us. Now, when you start learning trading as a fresher, or even if you have a lot of experience, but now you're learning a new methodology, let's say in this case, demand supply. So, what happens is you don't have expertise from day one. With time, with experience, you start getting better and better with your analysis. And during that period, when we are still learning that new methodology, since we are lacking that experience, we might not be able to create a trade plan for us, which can help us plan trades in a very mechanical and rule based way. So, to overcome this challenge, what I've done is I have created a ready made trade plan for you. And this is a conservative approach, but with time, with experience, you can make modifications to it to make it better suit with your personality style. If you're an aggressive trader, you can modify it to an aggressive version. If you are a very conservative trader, you can modify it to a very conservative approach. So, yes, based on your um, personality style, those modifications can definitely be done. So, what we'll be doing is we will be following this trade plan steps. You can also call it as the walkthrough or the flow chart, which guides us what we need to do as a demand and supply trader step by step. Now, every step has its own elaborate rule, and those rules are available in the rule book. And like I said, this is a conservative approach. Eventually, you can modify it based on your experience. So, what is our step number one whenever we start planning our trade? Our step one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose implies the duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, why are we starting with the trade purpose? The reason is that whenever we are doing our analysis, the charts that we use time based charts, and we have n number of time frames that are available to us. So, the very first challenge is that I have so many time frames available to me. So, out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we don't start by randomly selecting any time frames. We again go with a very logical approach, and that approach is that based on the duration of the trade, the expected duration of the trade, will be selecting our time frame. So if we are planning trades for shorter durations, we will be using smaller time frames. And if we are planning trades for longer durations, we will be using bigger time frames. So that's the logical follow: smaller durations, smaller time frames; longer durations, longer time frames. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important. By definition, I said daily income is a trade that can last for a day or few days. But when you're trading markets which are not 24 hours market, I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they gap up, some they gap down. Now, because of this gap up, gap down, what can happen is you can get profit which is bigger than what you were anticipating in case you have a gap in your favor. But if you have a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we keep a position overnight, by keeping the position overnight, we have that inherited overnight gap risk which cannot be avoided. So that is why my recommendation to all of you would be that initially your hourly dailies, do them strictly as intraday trades. Don't take that unnecessary overnight gap risk by keeping these positions overnight. For weeklies and monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice but to keep those positions as overnight positions. But that does not mean we cannot have a gap against us for weekly monthlies. It can happen, but the probability definitely reduces because we are leaning against some bigger time frames. But as you start having more and more experience, if you want to include daily incomes into overnight trades, that can definitely be done. But initially, do avoid it as a risk management rule. So let's assume here I opted I want to plan monthly income trades. Now, once I selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic that is multiple time frame analysis, because demand supply methodology is not based on one single time frame. It is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend. Lower time frame is used for demand supply, to identify the zones for our entries and exits. So where are the demand supply zones where I'll be entering and exiting the trade? And the refining time frame can be used for multiple purposes, like fine tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I opted, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly is the higher time frame used for curve analysis. Weekly is intermediate, used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. ACTS stands for stop loss entry target and size. And in case I need to use the refining time frame, then the refining time frame will be the 60-minute chart, which can be used for multiple purposes like fine tuning zone, type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Now mind that this table, which is on page number 31, is for NSE market specifically, because this market is only open for about 6 hours and 15 minutes. So it's open for a very small duration. That's why we have some time frames which otherwise we might not want to use. If your time, if your market, I mean, I won't say use, which we might want to modify if the markets are open for a longer durations. So that is why I also have another table on page number 32. So if you're trading markets which are open for longer durations, then we can refer to this particular table. This can be applied to commodities, to forex, to cryptos. But yes, specifically if I'm talking about NSE, which is open for a very short duration, you can refer to this table. So as soon as my step number 1 is done, now have the clarity to what time frames I'll be using. In this case, monthly, weekly, daily 60. Plus, I also know what analysis I'll be doing on each and every time frame. So my challenge number 1 is taken care. The next challenge is I do know my time frames, but on NSE we have about 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need now is a process for selecting some scripts that out of these 2000 companies, how do I select a smaller list? Because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 plus companies every day, it's not an easy task. So the way we do this is by using some computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then these scanner screeners, they identify that out of these 2000 plus companies, which companies are matching with those conditions. Wherever is matching, it gets shortlisted for us, and that is how we get a small list. Now, very, very important thing, no matter what scanner or screener you're using, whatever results you get, do not assume that you can blindly buy or sell them. The job of the scanner is never to tell you what you need to buy or sell. The job of the scanner is to get you a smaller list out of a very big list, right? That is the only purpose the scanner is doing for you. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you. And they are based on moving averages. Second example, if you search on my YouTube channel scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll have a video on that, which can again help you in shortlisting symbols. Fourth example, on the YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis, which can help you in the in shortlisting some symbols. So these are 3-4 different examples of scanner screeners, but you're not only restricted to only these 3-4 scanner screeners. Let's look at few examples before we move ahead. So like I was saying, that once you come to our website, you can see under the free tab, you have stock screener. Because I opted, I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 2 symbols for me. But like I said, just because these 2 symbols are getting shortlisted does not mean I can blindly buy these 2. So remember, the job of the scanner is never to tell you what you need to buy or sell. So the scanner is telling me, okay, that out of those 2000 companies, these are the 2 companies you can analyze. If any one of these, they match with your trade plan, they might be your trading opportunities. If they don't match, you don't have anything available. Similarly, if I look at the short scan, you can see it is shortlisting around 17 for me. So we have 17 plus 2, which is 19 symbols to look into. Now, many times what can happen is this list might be a very small list. Like you can see today, only 19 symbols, or maybe nothing is getting generated because nothing is matching with your conditions which you have given in the scanner. And even otherwise, if you feel that, okay, I don't want to look at a very small number, because the smaller the number, the lesser will be the probability you'll be able to find some opportunities that might match with your trade plan. But if you're looking at a bigger list, that probability increases. So even just because you want to look at a bigger number of symbols, if you want to have more symbols getting shortlisted out of these scanners, then what you can do is, you can see that in this scanner I have given 5 different conditions. You will disable the third one and you'll run the scan again, and I'll do exactly the same thing for the other one. I'll disable the third one and run the scan again. So now you can see initially it was only shortlisting 2 symbols for me, but now it is giving me a list of 27 from here. And from the short scan, I have 57. So we have 57 plus 27, which is 4 and 8, right? So we have 84 symbols to look into. So you can see from 19, now we are up to 84. Now, if you feel 84 is a very big number, you further want to filter it out, you can use different filters. You can say, okay, I don't want from the cash segment. I only want the ones which are also getting traded in futures. I can run the scan again and I can do the exact thing here, not indices, futures, and I can run the scan again. And now you can see I have 18 plus 16, right? So now the number is even smaller now. So this is how you can use different filters, different scanners to get a list which you are comfortable with. Plus, these are not the only scanners that are available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some of them are based on fundamental analysis. Then you have top left, candlestick patterns. If I further go down, you can see you have your range breakouts, you have your bullish scans, you have your bearish scans. Then you have your intraday bearish, you have intraday bullish, crossover. So n number of scanner screeners are available to you, and this is an example of one particular website. Similarly, if you'll do a Google search, you'll be able to find a number of websites, a number of scanner screeners. Whatever you feel out of that is the best fit for you, you can use that to get your list. So in this example, you saw that we got a list of about 84 symbols. Now, once you start analyzing them, a few challenges which you will eventually realize. Challenge number one will be that majority of the symbols in this list might not have a quality demand zone or a quality supply zone on the lower time frame, which means when you're doing your analysis, you might be wasting a lot of time analyzing such symbols where no quality zones are available, right? Which is definitely a waste of time. And the second challenge will be some of them which might have some quality areas. Those zones might be really far away from the current market price, right? So they can be far away from the current market price, due to which you'll have a longer waiting period before the prices are back. And during that waiting period, whatever price action develops, what can also happen is it might create some conditions on the chart which might disqualify the trade setup by the time it is back to your zone. So these are some of the challenges we face when we are using scanner screeners that are not based on demand supply zones, they are based on conventional technical analysis. And to overcome these challenges, I have also created two custom built tools, which is the alerts and the screener. Again, I'll add, these are not call giving or tip giving services, these are also scanner screeners. The only difference being that these scanner screeners are purely based on demand supply zones. If you want to understand them better, we have the link to the walkthrough videos available in the description, but I'll quickly just go through what these two scanners also do, like I just showed you the other scanners. So the alerts is purely based on the lower time frame, and what it does is as soon as you have a formation of a demand area or a supply area on the lower time frame, you get notified for it. So we do have demo channels for NSE, for MCX and Forex. So once you go through the walkthrough video, you'll be able to understand how you can join those demo channels if you wish to. But let me just show you example. You can see here that this is the alerts that were generated on the 5th of April, and this is from the NSE demo channel. So you can see on the demo channel, the alerts, they start from 11:15 Indian Standard Time and they end at 11:45 Indian Standard Time. So we only give the alerts for half an hour. So you can see that during that half an hour, we got an alert that at 11:15 we have rally-based rally zone which got formed on GMR Infra on the 15 minutes time frame. The proximal value is this, the distal value is this. Then you have IPCal Lab, and this is a rally based rally again at 11:15 on the daily time frame, proximal line, distal line, right? ICICI GI on the daily time frame, proximal value, distal value. So you can see these were the alerts that were generated till 11:15, right? At 11:15. Then you can see at 11:20 5 minutes, that 11:20 again on 5 minutes, 11:25 again on 5 minutes, 11:25 again on 5 minutes for these symbols. And then you have at 11:30 on the 15 minutes time frame for Apollo tires. You can see as in when the zones are getting formed real time, these alerts are generated, and that is what alerts they do. They keep updating you as in when these zones are getting formed. But again, I'll add, these are not call giving or tip giving services. So just because you're getting these alerts does not mean you can blindly buy sell them. It is just helping you shortlist symbols so that you know, okay, if you're trading during the live markets, you know which symbol to look into because that is where the zone has formed. Or even if you're doing your analysis at the end of the day, so now you know, okay, today these are the symbols where the zones were formed, so let me only analyze these symbols where we had formation of zones. So that's your alerts. Similarly, we have another tool which is called as screener. Now screener is not based on only the zones which are getting formed today. Screener is based on the proximity to a demand area or a supply area which might have formed today or might have formed, let's say, n number of days or n number of months or n number of years ago. So let me show you example of screener as well. So here you can see that I have a two chart layout. So on one chart, I have applied the screener. And in this screener, I have given a list of about 40 symbols. So let's assume that I'm a person who is planning MIT trades. Now, as an MIT trader, what I want is, okay, I have given a list of 40 stocks, but I don't want to waste my time analyzing 40 symbols. I just want to know that out of these 40 stocks, which symbols are within 2% of a demand area or within 2% of a supply area, right? So you can see if I go down, you can see here I've given my proximity range as 2%. So what it has done for me is that instead of me scrolling through all those 40 symbols and finding which ones are close to demand or supply area, it just gave me a list of 3 symbols close to supply, 2 symbols close to demand. So now, just as an example, if I go to TCS, you will see that TCS, the current candle will be within 2% range of a demand area, because can you see the shortlisting TCS proximity to demand, and you can see there you have your demand area, and the current candle is within 2% of it. Similarly, it is telling me NTPC. So now you can see my analysis time. Instead of going through 40 symbols, I just had to go through 2 symbols out of 40, because these are the two which are close to the demand areas. Now, this was an example of, let's say, somebody who's doing MIT trades. Now, let's imagine that I'm somebody who's into WIT trades, and I only plan my trades at the best locations. So I want to know that out of these 40 symbols, which symbols are trading currently inside of a weekly demand area or a weekly supply area, because that would imply that I'm at the best location, and that is where I like to plan my trades. So now what I can do is, because I want to be inside the zone, so the first thing will be that the zone will be tested. So I have to check mark show tested zones, and because I should be inside, so my proximity method should not be based on high and low. It should be based on the closing. So now my closing will be inside of the zone, and because it has to be inside of the zone, the proximity has to be 0%, right? Because 0 means I'm either touching the proximal or I'm inside of that proximal. And because I want it on the weekly time frame, I'll change my time frame to weekly, and now you will see it will generate the list for me. And you can see it hardly took me maybe 20 seconds to look into those. In fact, let me do this again. Let's change it to weekly. And can you see, as soon as I changed it to weekly, it will probably take 15-20 seconds. And the so what is happening? Calculation timed out. So if this happens, you can just refresh it, because it has to go through 40 symbols. So it can happen at times. Let me see, did I change some settings here? So I need tested zones based on closing. All right, everything is perfect. So what I can do is I can just go back to daily, and I can again come back to weekly, and then it should generate the results for us. So let's give it a few more seconds. So generally it does not happen, maybe some backend issue, but now you can see it hardly took maybe 15-20 seconds, and it is telling me that now I don't have to analyze those 40 symbols. Asian Paints is the only one which is currently inside of a weekly demand area, and out of those 40 symbols, these are the two which are inside of weekly supply areas. So if I just show you as an example, Asian Paints, okay, so you can see if I open Asian Paints, the current candle will be inside weekly demand zone. So let's just wait for it. You can see we have a weekly demand zone. We are currently inside of it. And similarly, if I take any one of these, let's say Coal India, you will see Coal India will be inside of a weekly supply zone. So here you can see we have a weekly supply zone, and currently we are trading inside of it. So that is how the screener works. So screener is not telling you based on what is getting formed today. It is based on your proximity settings. So yes, now you can see you have a number of ways of shortlisting symbols. I showed you over 150,000 scanners on just one single website, which are absolutely free, and they are based on either conventional technical analysis or fundamental analysis. And I also showed you two tools which are purely based on demand supply zones, and one is based on the formation of the zone, the other one is based on the arrival back to the zone, so how close you are to the zone before it gets shortlisted for you. So whatever you feel is the best fit for you, that is what you can use. Obviously, if your screener is more in sync with demand and supply, it becomes much more easier to identify opportunities, and plus the probability of finding something that matches with your trade plan also increases. But again, I'll add, these are not mandatory tools, these are optional tools, because at the end of the day, what you want is, from your step number 2, I want a smaller list. Now how you get that smaller list is completely your choice, and that can be as simple as, I don't want to look at any of these scanner screeners. I want a small list, so I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I might want to analyze every day. So choice is yours how you want to get your list, but you will have to use one or the other way to get a list for you, because if you don't have a list, you can't analyze 2000 companies every day, right? So again, this is example of the Indian markets. If you're trading some other markets, you might have some same challenges, but these tools can assist you in anything that is available on trading view, right? Be that the Indian market, US market, European markets, any market. So again, let's assume we got a list, and that list, the very first symbol was ABC. So we'll start with the analysis of ABC. If it matches with our trade plan, we have an opportunity. If it doesn't match, we move on to the next one, then the next one, then the next one, and that is how we shortlist our opportunities. So the next step now is to go to the lower time frame. So the question now is, what is my lower time frame? We got the answer from our step number one, that as a monthly income trader, my time frames were monthly, weekly, daily, and 60, out of which daily was my lower time frame. So here daily implies lower time frame in this case. And what I need to do there is I need to identify a zone. By zone, we mean any of these four structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. Now, whenever we talk about demand supply methodology, always say it's a price action based methodology. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things. It can either move up or move down. It cannot do anything else. But when price is moving in a narrow range, we call it as the period of pause, or we can also call it as the basing. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So that is the time what we can do is we start with a concept to start training our eyes how these zones might look like on the chart. And to train our eyes, we use a concept which is called as boring exciting candles. Now, I have created the boring candle indicator, which is available on TradingView. It's an absolutely free indicator. You can use it for free forever. Similarly, I've also designed another indicator which is called as the explosive move indicator. It is also 100% free. You can use it for free forever. So initially, yes, you can use the combination of these two indicators, the boring candle indicator and the explosive move indicator, to help you, help you identify how these structures might look like on the chart. And once your eyes are trained, then what you need to do is eventually from boring exciting, you'll start shifting towards the price action, right? Where do I see that period of pause? Where do I see those structures? So very simple example, if I just disable the demand supply zone indicator and if I zoom out, you can see that if I'm starting from the current market price, I have a nice rally based rally structure. Similarly, you can see I also have a rally based rally structure here. We moved up, we paused, we started moving up. Similarly, you can see before that we had this drop, we had this base, and then we have a rally. So yes, once your eyes are trained, the same thing can be done without the use of any indicators. But initially, the indicators can make the process a little mechanical for you to start training your eyes how these zones might look like. Now I'm using the demand and supply zone indicator, which is a subscription based indicator, and it is more like your GPS that you don't have to identify. It will automatically identify the zones, automatically plot the zones for you. And now you can see that it is showing me that yes, above the current market price, we have a supply zone which has already been tested twice. You can see we came into it, we got the first bounce, we came into it, then we got the second bounce. And then we also have 1, 2, 3 demand areas between, below this. So this is what I was talking about, that at times the challenge can be that I have multiple demand areas or I have multiple supply areas. So which one should I be using, right? That's a very common question. Now today it's a very beautiful example of how to decide it, right? Because there are some uh, rules that at times I talk about, that somebody might be having this kind of a rule, somebody might be having that kind of a rule, and this is almost a textbook example today. So the first thing is, how do I decide which zone should I be using? The rule is very, very simple. The rule simply says we always use the nearest and qualified. Now what do I mean by nearest? By nearest I mean the zone that is nearest to the current market price. So this is my current market price, which is the demand zone which is nearest to this current market price. This is the zone which is nearest to the current market price. So that's the first part, nearest. The second part is and qualified. So this is nearest, but does it qualify based on my trade plan? If the answer is yes, I will use this demand area. If the answer is no, then I'll skip this, then I'll check the next nearest. So next nearest will be this, and then I'll check, does it qualify with my trade plan? If the answer is yes, I'll use this one. If this also doesn't qualify, then I move on to the next one. If this also doesn't qualify, then I can zoom out. I'll also be having more zones in the past, right? So you can see that's the first one, second one, third one. Now that's the fourth one. So as you keep moving out, you will have more number of demand areas or supply areas on the chart. And you always have to use the one which will be closest to the current market price, but along with that, it also has to qualify based on your trade plan. So in this scenario, let's start with the very first one, which is this demand area. So that's the nearest demand area from the current market price. And my step number 3 now is complete, which was identify a zone on the lower time frame. Do we have a zone available? The answer is yes. Now, once you have identified the zone on the chart, does not mean you can blindly trade it, and that's the biggest mistake demand supply traders they do initially. They find any demand area on the chart, blindly start buying. They find any supply area in the chart, blindly start selling, which is incorrect. Once you have identified your demand area or supply area, the next step is to qualify it. And for qualification, we have a two-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify it based on the booster scoring. So the first thing we'll check is that the zone I've identified, is it a case of level on top of level? And why are we qualifying that? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. And how do we verify that? It's a very simple concept. So let's assume that we have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So whenever your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand from this is that to be a case of level on top of level, my lower time frame zone has to coincide with the intermediate time frame zone. So if we have a coinciding level, it might be a case of level on top of level. But if we don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? So if I go to my intermediate time frame, which in this case will be the weekly, here you can see we have a drop based rally structure. So let's mark the zone, and I'll mark it with a different color so that we can differentiate between the two. Now the one marked in pink is your intermediate time frame zone. The one marked in green is your lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is no. And since my lower time frame zone is not inside the intermediate, it is not a coinciding level. And if it is not coinciding, it cannot be a case of level on top of level. Right. So the first thing is, if you talk about level on top of level, we know this is not a case of level on top of level. So we don't have to make any modifications. So yes, we can move ahead. But before we move ahead, now let me also talk about another approach here. So as if now what I'm doing is I'm talking about a person who's following the rules that I've given you in the rule book, right? So that's person A. And for that person A, as if now this zone is as if now, right? So the step at which we are as if now, this is a zone which is usable for me. Now let's assume we also have a person B, who's a trader, and he is a very conservative trader. And as a very conservative trader, his rule is that whenever I'm planning my trades, my lower time frame zone has to be a coinciding zone. If it is not a coinciding zone, I'll not use it. If it is a coinciding zone, only then I will use it. Now for that person, what he can see is that this zone is not coinciding, but this lower time frame zone, which is a drop based rally, is a coinciding zone, because if I draw this one, you can see that this green zone, which I have now marked as the lower time frame, so this is my LTF zone, is coinciding with my intermediate time frame zone. So again, person A who is following the rule book, for him, as if now this is a qualified area. But person B who is extra conservative and says, I will only be trading coinciding areas, this is not qualified because this is not coinciding. This is not qualified because this is not coinciding. So that person will disqualify this zone, and will only wait for this area, because that is what his trade plan says. So that is what I mean by nearest and qualified, right? So this is nearest, but for person A, this is, for person A, this is definitely qualified. This is nearest, but for person B, this is not qualified. Similarly, this is the next nearest, but for person B, this is also not qualified because it is not coinciding, right? But for person B, this is nearest and also qualified based on his trade plan because it is a coinciding level. So always remember, this is how we decide based on your personality style, how conservatively, how aggressively you're trading. That will define your rules, and whatever matches with your rules is the one you will be using. Now, if I talk about me personally, if I am planning my trade, I will definitely go for the lower one. I will not use this because that is what I prefer. Right now, it has its own downside can be price can react from there, I never get a fill. Price can react from the second one. In fact, let's draw it again. From second one, I might never get a fill, right? So that is where I know that if I am shifting to this, I'm also being conservative at the cost of maybe missing some trades, right? But at the end of the day, you have to decide whether you want to be conservative, whether you want to be aggressive, right? An aggressive trader might say, okay, I'll trade the first one if it qualifies. If it gets stopped out, then I'll also trade the second one if it qualifies based on my trade plan. If this also gets stopped out, I will also trade the third one based on my trade plan, because nobody knows whether this will work or this will work or this will work. So you will have to decide eventually based on your experience which one you would like to go for. Like I said, if I have to make a choice, I would definitely go for the lowest one, because this is a coinciding level and that is what I prefer. So it's not that I always choose coinciding levels, but now because I can see that I have some zones which are pretty close by, so if I want to make my decision as a conservative trader, I'll be more inclined towards this one. So just as an example. So yes, let's go back to the first one. So yes, it is not a case of level on top of level, because it is not coinciding. Gap rules will also not apply. Pivot nor authentic not applicable, because we only apply pivot nor authenticity to drop based rallies and rally based drops. And the last one is unstable equilibrium. Unstable equilibrium is also not applicable, because the leg out is not going below the basing, which you can see here. If the leg out was something like this, then we would have called it as unstable equilibrium. So if we talk about all these conditions, none of these conditions are getting applied, and if these conditions are not getting applied, they cannot disqualify the zone, right? To disqualify the zone, first they need to be applicable. Then there can be two possibilities, either qualified or disqualified. But if they are not getting applied, they cannot disqualify the zone. So is the zone qualified for us? The answer is yes. So now that we know that based on these conditions, the zone is qualified, we'll move on to the next step, which is the booster scoring. So let's go back and let's start applying the boosters. So the very first one is freshness. The zone is definitely fresh, gets a score of 2. Sorry, 3, my bad. Talking about strength, we have a score of 2 because it's an explosive move. Time at the zone, just one candle, gets a score of 2. Reward to risk ratio, will take it as an assumption. Next is the location. Now, if I go to the monthly time frame, you can see that the indicator will also do the curve analysis automatically for me. Why? Because you can see in the indicator settings, I've already defined my higher time frame, intermediate, refining, and I've also checked marked the automatic settings, because once this is checked, whenever you will go to these defined time frames, these settings will apply automatically. So on the monthly, it is automatically applying all zones and curve analysis for me. So that is the reason as soon as I went to the monthly, it did the curve analysis for us, and you can see that this is my very low of the curve, this is my low of the curve, this is my middle of the curve, high of the curve, and the very high of the curve. So where is my zone located? My zone is located in this green shaded area, which is called as low of the curve, and low of the curve is a good location to plan a long trade, therefore gets a score of 1. Next, what is my trend? If I go to the intermediate time frame, that is where we do our trend analysis. You can see in the indicator is telling us we have 2 violations of supply, and if supplies are getting violated, that means prices are making new highs, which can only happen in an uptrend. So violation of 2 supplies makes it as an uptrend. That is why we'll give it a score of 1. Next, move from the zone, we need minimum 4:1, which has not yet happened, but it can happen eventually. So if I talk about as of today, you can see we just have about 1:1 move, 4:1 is somewhere around here. So as of today, we'll give it a score of 0. But what can happen is prices can continue moving up and then come back into the zone. That is the time we can upgrade it to a score of 2. But based on the conditions we have as of today, we'll give it a score of 0. It was not a case of level on top of level. We have already verified that. It is not even coinciding. We have already checked that. And this one, I think it will also get a score of 0 for trap. Why? Because if I take a horizontal line wherever the proximal is, and if I zoom out, and now if I start pushing it up, trying to find an area where the prices have been bouncing over and over again, you can see that above this, we don't have a very clean area, right? You can see even if I come to this level, yes, it has acted like resistance, resistance, resistance. But here you can see it never acted like resistance. We can't even see it working like support in the past. So we ideally want a very clean area which immediately catches your eye when you're talking about this support and resistance, because if you're struggling to find it, probably everyone is struggling to find it, right? So unless and until it is just standing out as soon as you see it on the chart, you don't have that kind of a setup available to you. So this will be a score of 0. So if you look at the overall scoring, we have a score of 10 out of 10 for quality, which makes it as a high quality zone, and 2 out of 8, which makes it as a low probability zone. And high quality, low probability can be done as a type 2, type 3 trade, but this can change provided we move up first and then start coming back, which will give it a score of 2, thereby making it as a type 1 trade. So based on the arrival, it might get converted into a type 1 trade, but as of now, it is going to be a type 2, type 3 trade for us. So yes, after applying the boosters, we got to know that if we want to trade this, it has to be done as a type 2, type 3 trade. Let's move ahead. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we'll also have to be ready for the worst case scenario, for which we'll do a proper position size calculation, so that in case the trade does not go in our favor, we do not lose more than what we are willing to lose based on our risk appetite. Next, whenever the prices are back, we'll have to re-verify, because the markets are not static, they are dynamic. Conditions are changing almost every other second. So before jumping into a trade, we'll have to re-verify it still qualifies based on my trade plan. If the answer is yes, you place your order based on the entry type, and the last step is your trade management, where first step is 1:1, we make it as a break even trade, and after that, if we get the opportunity to trail onto it, we start using our trailing stop loss until and unless we get our exit. And that is how we plan trades, very mechanically and very rule based. So that takes care of the example we had for today's session. Now, let me look into the chat box. I'll take some questions, queries randomly. But again, before I start with that, I'll add, if you're liking these sessions, do like the video, share it with your friends and family members. If if you're on some trading groups, also share there, because you never know who might get advantage of these sessions. So let's look into what we have in the chat box. So can you try to show the SL by TP? I think you mean the target, and in each entry. See, that is what we are doing now. In this case, can you see this is going to be my entry price, right? Though I'm not sharing the price at the time of analysis, but I know when it comes to this level, that's going to be my entry. This is going to be my stop loss. Now, if you talk about the target is always your opposing fresh area, which is available on the lower time frame. Now, in this case, you can see this is a tested area. So if I want to look for fresh, I can zoom out. Plus, for targets, you don't require quality zones. Any demand zone, any supply zone which is fresh will do. So let's change these settings to all zones, and let's wait for a few seconds. So you can see we don't have any fresh areas here. If I zoom out further, now we might have some fresh areas which will start coming up. So you can see this is also tested. So you can see as if now we don't have, okay, now we do have. So you can see the nearest fresh area is pretty far away. That is where you have your fresh zone. But that does not mean that this is going to be my target, because what can happen is prices can move up, it can base and then start coming back, and we might have a fresh area of supply by the time we are back. So wherever is your fresh area of supply, in case you're taking a long trade, that is going to be your target, right? The proximal line of that zone, again, just before the proximal line, that is going to be your target. So yes, when you're talking about your stop loss, entry targets, everything is there. Probably maybe you have not gone through the theory part. So if you go through the theory part, you will have the clarity to it. So proximals are your entries, distals are your stop losses, and the opposing zones will be the targets. All right. Next question is, can you show how to identify a valid and qualified zone? So that is what we are doing in every session, right? Today is our session number 14. So you will also have all the previous 13 sessions available to you. You can go through all those 13 sessions. Every session we are doing exactly the same thing, applying the complete methodology, understanding how to qualify a zone and validate whether this is something which I can use or I should not be using based on my trade plan. Or at very late night, it should be in the evening. So again, the problem here is we have people joining from all over the world. So yes, for some people, I know it will be late. For some people, it might be even too early. But the good thing is these sessions, they get recorded. So in case it is late for you, you're not able to join live, you can later watch the recordings. But I will definitely like to add that I have another channel which is called as Trading Munch. And on that channel, I do the same analysis in Hindi. So if you're comfortable in Hindi, that session happens at 2 p.m. Indian Standard Time. So if you're okay with the Hindi, you can even join during the afternoon, which will be the Hindi session. But again, the problem with me would be that since people are joining from all over the world, some or the other person will face this challenge. But the solution is, one, if you're comfortable with Hindi, you have another option which is available to you. But if that also doesn't work out, then the recordings are definitely available to you. All right, so how do I get to have the booster sheet that you use during the live session? Second, okay, let me answer the first one first. See, now this is a very simple sheet where you just are giving the numbers, and here you're just doing the sum of it. Now, I have not shared this sheet purposely in the download section, and the reason for that is that this can only be used for someone who has a very good experience with demand supply trading. Why? Because here you have to give your scoring, right? And you can make a mistake, the sheet will not say anything about it. Example, even if I give instead of 3 I give it 30, the sheet will accept it, right? If I give it as 21, the sheet will still accept it, right? Because this sheet does not know what is the maximum scoring I need to give, right? Plus here you also need to understand that at what location you are, what is the trend, based on that what is the correct scoring. But the one which I've shared for you, that is where you don't have to give the scoring, you have to select the correct condition. As long as you're selecting the correct condition, the scoring is given automatically, and that will never make any mistake. So that is why this one I don't share purposely, because this has to be done manually, and when you're doing it manually you can make mistakes because of lack of experience, because of typo errors. So that is why this one, again, if you want to create it, it's not a rocket science, it's just a a total of all these numbers, and it's just a total of all these numbers, right? But I don't share it purposely, and the reason is because this is a manual process where a lot of mistakes can be done. That is why I only use it myself. And here, the advantage is that at one go you're able to see all the scoring. The other one is laid horizontally, where at one go you're not able to see all the scoring. So that is the only reason I use this during the live session. All right. And when using the scanner, can you choose two trade purposes, or will it cause information overload as a new trader? See, when you're talking about using the scanner doesn't know what purpose you're using. The scanner will shortlist for you based on what time frame you select. So example, if I again go back to the scanner, because currently I've selected weekly, it is doing the scan for me based on the weekly. If I go to monthly, now it will do the scan for me based on the monthly. So I have to decide what is my purpose of trade, what time frames I need to use, and for that purpose of time frame, what settings I need to put into the scanner. So once you have put that conditions into the scanner, whatever time frame you'll select, it will just do the same analysis for you. Now, can you see it is telling me that if I want to find symbols which are currently trading inside of monthly demand areas or supply areas, then nothing is in supply, but we do have Asian Paints, which is in monthly demand. We also have Kotak Bank, which is in monthly demand. So if I go to Kotak Bank, you will see that it will be inside of a monthly demand area. And here you can see it, we're inside of a monthly demand area. Though it has been tested once, we are again into it the second time. Similarly, if I'll go to Asian Paints, and again, this list is not restricted only to the NSE exchange. Here also you can see we have a demand area, and now we are inside of that demand area, and that is why it got shortlisted for me. So can you see, that's the beauty. I don't have to go through the complete n number of symbols. And similarly, you can have this screener applied to n number of charts, and you can have n number of symbols it is analyzing for you. So if you want to change, you can see here, you can change it to any symbol that is available on TradingView. So it's not just restricted to the NSE exchange. Whatever symbols are available on TradingView, it can be applied to any symbol. All right, so that answers your query. Next, let's assume I opt for WIT purpose. What settings will I use for Forex in supply and demand indicator? Getting confused because I thought there was option to select LTF, but I see only RTF. See, the reason okay, so when it comes to the indicator, whatever settings you're keeping, right? Let's ignore automatic settings for a minute. In fact, let me go back to the first one, right? So let's ignore the automatic settings for a minute. So if you ignore the automatic settings for a minute, whatever settings I'm doing here, that's basically your setting for the lower time frame, right? So that's my settings for the lower time frame. But when we define our monthly, I mean the HTF, ITF and RTF, that is where these settings will get applied, right? So on these three time frames, these are the settings that are getting applied. And other than these three time frames, whatever settings you have kept, that will be taken as an assumption that it's your lower time frame, and those are the kind of settings you want to apply. So example, on the lower time frame, if I want that it has to be explosive, I can change it to explosive, and I would only identify zones which have explosive moves. Can you see the other two? It is not identifying for now because I had given it good. It was also identifying the other two. So yes, the settings which you will give by default is for your lower time frame, and on the other three time frames, which is higher, intermediate, refining, only these settings they get applied. Alright, so that answers this query as well. If I choose MIT screener, I need to run it daily. See, if you're using MIT, now depending upon how you are doing your scan. So example, if I only want to identify symbols which are inside monthly demand area or monthly supply area, because I want to do my analysis, let's say every, I mean only I mean I want to plan my trades only at the best location, then I might say that yes, you may run scan every alternate day, still acceptable, right? Because what can happen is I might not be in a monthly demand area today, but I might be in a monthly demand area tomorrow. So you will not have to run it multiple times in a day, but at the end of the day, if you're looking at it, it might identify something for you. Similarly, if you're applying it on the lower time frame, then today I might not have a formation of a zone, but tomorrow I might have a formation of a zone. So yes, at least I'll say if you're running it every day, at the end of the day, if something has entered at the best location and that is the kind of scanner you're utilizing, it will help you identify that. And even if you have a formation of a zone during the day, that is also something you'll be able to identify. So that answers this query. Right, let's see. Next. Thank you for showing various nuances to identify quality zones. It provides the base to build good trading habits. See, yes, and that is why I decided to do these practical sessions as well, because I know that if I just provide you people with the theory, yes, learning theory is something which is definitely going to help you, but unless and until you have that practical application of it, you don't get that clarity. And that is the reason behind why I do these sessions every week. And you will see that even though we are applying exactly the same thing every day, every session we have something new to learn. Because when you're learning in a theory, you're learning the theory, you are learning basically which is just from textbook examples. But when you're looking at the market, you don't get textbook conditions for every setup, right? You will have different conditions, and that is what you will have to learn how to navigate through. So eventually, the more number of sessions you will see, the better you'll start having your understanding. But eventually, what you will realize is that, see, as of now, we have just been through 14 sessions. But once you have been through, let's say, 50 sessions, 60 sessions, then what you'll also realize is that, the same conditions are getting repeated over and over again. So yes, initially 14, 15 sessions, you might find something new to learn. But once you have gone through 50 sessions, 60 sessions, let's say 100 sessions, then you will realize, okay, now we don't have anything new because these are the conditions we have also seen in the past. So yes, initially you might have to go through quite a few sessions, but eventually you will have almost every kind of example you would have ever thought about. We would have covered it, but yes, it is gonna take some time. But yes, again, that's the main reason why I do these practical sessions, and I try to pick as unique examples as possible when compared to the sessions which I've already done in the past, so that you people can uh, understand how to navigate through those conditions. All right, let's see. The flowchart clearly illustrates to re-verify when price is about to enter the zone, so you can update the booster. Just follow. Absolutely great. Let's say, kindly please clarify quality zone. So a quality zone means based on your trade plan. So let's say if you are somebody who says, okay, I will only be trading zones which are 10 out of 10. So your quality uh, score will be only if I have a score of 10, that is the zone I want to use. Another person might say, okay, I'm comfortable, anything that is 8 or above 8, I'm okay using it. So that's the quality scoring for that person. A third person might be a very aggressive trader. He might say that even if it is a score of 5, I'm perfectly okay using that zone. So you have to decide what is the best for you. Now, generally, what I do is I don't use anything which is less than 8, right? That is what my preference is. So when it comes to 8, we are still okay with it. In fact, even 7 at times is okay as long as the probability is helping you. But anything which goes less than 7, ideally, I would like to avoid. And similarly, for probability also, if you want to make some modifications, those modifications can be done. But yes, the higher the scoring, the better it is for us. So eventually, based on your experience, how conservatively, how aggressively you plan, plus also depending upon what kind of time frames you're using or what purpose of trades you're doing. So what I'll add is, if you are doing trades on very smaller time frames like your HIT trades, DIT trades, then the better the scoring, the better it is for you. But once you start getting into, let's say, MIT trades, that is where you can be a little bit lenient with the scoring as well. That I don't always want 10 out of 10. Even if I have, let's say, an 8, I'm still okay with it, because the bigger the time frame, the higher the weightage. So those things also vary based on what time frames you're using for planning your trades. But yes, quality scoring means freshness, strength, time at the zone, and the reward to risk ratio on arrival. And based on your personality style, you can decide what kind of scoring you would like to use for the zones that are qualified for you. Thank you for another great presentation. I hope you continue to show different. Yes, that is what I try every other session, to show you different scenarios. Please show one more example. See, again, during this these sessions, we'll only be able to cover one. But yes, you do have the archive available to you. Like I said, as of now, we are on the 14th session. So we have 13 pre recorded, which are already available to you. So if you want to look at more examples, you can go through those 13 sessions. And I think by the time you're done with those 13, we'll be on our 15th session where again you'll have another example to look into. All right, remind yourself to double check your results when filling in booster scoring spreadsheet. The values need to make sense, otherwise you will. Absolutely, I agree with that. And perfect. So that brings us to the end of today's session. Thank you so much for joining in. Next, I'll be seeing you the next weekend. Till then, stay safe. Enjoy your Sunday evening. Take care. Bye bye.